let's think about this. Expense. It could be expense. Could be. Let's see what happens. This is one way to do it, okay? Because we have a this is one way to do it. Nothing wrong. Because you know when we talk about expenses increase is on debit side, right? So at least this is one method to make the whole thing balance. 970, 30, total 1,000, and on the credit side 1,000. So this is one method. All right. Can you think about another method?
Accounts payable?
No. There's no comparable issue. Nothing. It's fine. We can talk about that. My question is, do you want to trade this $30 as expense or something else? Either way, okay, I will give you another way, but either way, the result will be the same. The result will be the same. The thing is, for the analysis, is this $30 is really the expenses, or this $30 is something else?
It's a bank fee.
You do like,
Go ahead.
It's a bank fee.
Bank fee could be traded as expenses. It's okay, no problem, no doubt.
you do like a contra revenue account, so it doesn't subtract
Very
from
good,
net
very
sales.
good, very good. There's another concept. Okay, this is another concept. Instead of trading as expenses, you're trading as minus revenue. It's a very strange terminology, okay? In the book, okay, there's one terminology called contra account. For each account may come with contra account, okay? Contra account means negative. So the upper one, the option one is treated as expense, but expense is expense, okay? Expense is not revenue account. Expense is expense. And Justin just mentioned another way is treat this $30 as a revenue account, but negative revenue. And in our book choose this way. This $30 is not really expenses. You trade it as your revenue reduced by $30. It really means when your company make this sales, the sales is not really $1,000. It's more like the customer only paid you $970. Understand? I believe everybody agree, okay? Even the same item could be sold as 1,000 or sold as 970. That is your choice. There's no any law require you to sell at a certain amount. So the other way is you trade this $30 is not really the expense. It's more like when your company made the sales, it's only sold at the 970. So if we don't use this method, we create another account. It's called revenue account. Still revenue. But contract. In our book, you use X. Okay, say XR or RX. That means the negative revenue. So $30 here is not expense. This $30 offset the revenue $1,000. Remember, on the day we made the sales, we already entered revenue here. See? So in our book, it does not trade $30. It does not trade bank charge as expense. It traded as a revenue reduce. Each way is okay, but I think our book, adopt this one is more follow or comply with GAAP. So this is another example of GAAP. But again, doesn't matter which method, your result is the same. However, if you use this method, by the end of the period, you report your revenue 970. If you use the other way, you report your revenue as a 1,000, but your expense increased by $30. So the bottom line result is the same. However, it related to your analysis. You related to your analysis because accounting by itself means nothing. Accounting, all of the number generated from the accounting is for the manager or for anybody to do the analysis. Yes.
Is there any tax issue between these two?
No, there's no tax issue. Again, maybe. Yeah, maybe. Yeah, the tax issue is related to the sales tax. Maybe. Understand? Yes. Yes, a lot of consideration you can take into. Yeah, that's another good suggest. If you use $1,000 as a revenue, then you use $1,000 to calculate your sales tax. So you will increase your sales tax. Understand? So a lot of reason, but again, for the accounting, okay, there is no absolute good or bad. Maybe you win something here, you lose something else. Yes.
Yeah, the thing is that during the instance of selling, you occur the sales tax, right? But at the same time, by the end of the year, you need to report income tax, right? So the revenue, if revenue decrease, then your profit decrease, and your income tax reduce. Right? But the sales tax at this moment, if you do this reverse, then are you going to return that sales tax to the buyer, or how does that work?
Right. If your company based on $1,000 before to calculate your sales tax, and it's only at the cutoff day, so you already paid off your sales tax to government based on $1,000 already, and by the time when you receive the money, you reduce by $30. Then for the second period, then you just reduce your revenue by $30, so you get even.
Then do you post that
Yes.
whatever back as a credit to the buyer?
Yes, something like that. You offset.
That's
Right. So this is another thing. How about return? Let's change this whole scenario. You made the cash sales. Your company made a cash sales. So when you sell $1,000, your company receive $1,000 cash. So there's no problem. Cash debit 1,000 and revenue credit 1,000. However, the second day, the customer return, not all of them, return a portion and $100. When you do the return, how did you enter into your account? When the customer returned, we have not touched inventory yet, okay? Leave it alone. Don't think about inventory. We only talk about revenue issue. So when the customer return $100 value merchandise,
So cash credit $100.
so cash reduced by $100. How about revenue?
And then what is the contract?
The same thing, control account. So you see why we need to set out the control account. Same thing happened. If the customer returned, then your revenue reduced by same amount. All right. Okay, let's talk about inventory issue. Okay, when your company made $1,000 sales, assuming it's very simple, okay, very simple. In real life, it's very complicated. Assuming here is very simple. You only deliver one same kind inventory. It's the same kind inventory, and even simply more. Okay, the value of inventory is $700. How did you do the whole thing? Let me say it again, okay? When we just made $1,000 sales, you receive 1,000 cash. So right now we leave the revenue issue alone. Right now we focus on the inventory issue. You deliver the merchandise from your inventory, and the cost of the inventory is $700. How did you enter into your accounting? For example, it's called inventory A. Inventory number A, like Apple.
Inventory, the assets decrease.
Inventory is assets. Decreased by 700. So you want to do what? Inventory A credit by 700. How about the other side? The other side we have not touched yet. The other account we have not touched yet so far. This is the first time.
Yeah.
Any account you want to pick? And that's a major thing for today. That's a major thing. What is in your mind? When you reduce inventory, you have credit 700. So you know you must pick up one account which can bring you 700 debit. What kind of account increase 700 will record it on left side. You see the ball. Which category will increase is on the left side. There are only two categories. If it is not assets, it must be expenses. Right? It must be expenses. Right? I can tell you it is not assets. Okay, there's one account, we will see it.
Cost of goods.
Yes, cost of goods sold. Cost of goods sold. Some people say CGS. Okay, initial is a CGS. Cost of goods sold. Basically, cost is different from expenses. However, when we do the accounting, we put them together in the same category. Can anybody tell me what's the difference between cost and the expenses? Easier understanding. What's the difference between cost and expenses?
Cost for producing the goods and expenses while you're selling the goods.
We can say this, right? Because as I say, we don't have time to discuss cost accounting. Cost accounting is a big issue. Everybody hate it, okay? But it's so important. So the easy way to understand the difference between the cost and expenses is more like the cost related to production. Cost related to production, either to goods production or to service. But when you produce something, you have cost, right? So cost directly or indirectly related to your product, right? This cost. And expenses is more like administration, like rental, like a salary. When we say salary, is not for labor. Labor is more cost, okay? If you pay to the assembly worker, that related as a cost. However, the salary paid to the CEO, secretary assistants is more like administration. That's called expenses. So cost and expenses, they are different. However, when we do the accounting, we put them under the same category. So you can see why cost of goods sold is same as expenses. When cost of goods sold increase, is on the debit side. So right now it balanced, right? So when we say $700, inventory reduce is on the credit side. Cost of goods sold increase is on the debit side. So we have a $700 on each side, so balance, right? So it makes sense so far. So far so good. Then you apply the same concept to the end of the period. You will see your company carry $1,000 revenue on the income statement, right? Then you see $700 as cost. So the bottom line you can see $300 as profit. By the way, everybody, profit is not one account. You see there's no profit account here. We don't see profit here. Why? How come there's no profit account? Why? Any reason why we don't see the profit account? Right, because either it's profit or loss is the result. Understand? We don't need to create the account named as profit, because as long as we done the right job for revenue and to expenses, the result come out as either profit or loss by itself. So that's the reason why when we talk about accounting, we only talk about 5 categories and not include profit. There is no profit account, there is no loss account, because it is the end result. And for each sales, we do not calculate profit or loss. It does not make sense to small business, by the way. If this is your one-person business, and we are so anxious to calculate how much money I made. Say for example, you done any business on the eBay. If you open your eBay store, you are so excited you just make sales, okay? For each transaction, I believe you will calculate how much money you made. However, for the accounting, you don't need to, because that number come out at the bottom line as long as we do the right number. Understand? Alright. But here comes the problem. Here's kind of big problem. Because we just simplify the reality by too much. In real life, life is not that simple. Assuming we deliver the same item, we just keep the same assumption. So lucky, okay? We deliver the same item. The problem is the inventory coming in at different price. Let me give you an example, okay? Let's go like this. Say on the, so the whole thing come up with a FIFO LIFO issue. Okay, FIFO LIFO. By the way, for next week, more likely than not, okay, your midterm exam is FIFO LIFO issue. All right, so you better off be clear about this, okay? And FIFO LIFO issue is also another good topic for your final project. If you want to finish your final project earlier and you have no any other better topic to choose, or you don't want to wait, maybe choose FIFO LIFO issue. Okay, on this day, again, it's item number A. We'll keep the same item, keep it simple. Your company purchased, okay, 1,000 units. At $1. Assuming your company pay by cash. Okay, so the payment is not the issue we're gonna discuss right now. We don't care about the payment issue. So this item A, 1,000 units delivered to your warehouse. You pay $1,000 cash. So at this moment, should be very easy, right? How did you enter into your bookkeeping?
that paying cash or
Yeah, paying cash.
cash decrease?
So this is the easy part. This is the easy part.
Inventory.
And inventory A.
Increase.
You increase by, but you're better off make a note. Okay, this is $1 times 1,000. Also make a mark here. This is the May 5th purchase. All right, you need to make very, very detailed. You just not enter into 1,000. Otherwise, you mess up everything. You will mess up everything. All right. Then, without any sales, your company purchase more, right? So on this day, the price just went out a little bit. Pay cash again. All right? Because your company predict some of the customer gonna place order very soon. So your company start to look around different vendors, try to get as many as possible. Try to get this in. So here you have May 9 purchase. This time is total 1,500. But this is $1.50. Again, pay cash. So far so good, right? Anyone got lost here so far? Everybody on the track, right? Okay, here on this day. You bought 2,500 units at $2. Make it easy. Make the number even. So here you have a total 5,000. This is May 11. $6. Here. Okay. Finally, on May 12, your company made the sales. Okay, made the sales finally. Say 3,500 units sold to one customer, $3 for each. Okay. So what are the sales here? Cash or payment term, I don't care. Okay, so on sales day, let's make the revenue part first because that's easy. Then we talk about inventory issue. And just give you a hint for meter increase is very similar to this. More complicated, okay. But right now, let's talk about the sales revenue issue. So this is 10,500, right? Am I right? The sales total is 10,500, right? Cash. So this part is easy. How do you enter into?
Cash increase. Revenue.
Cash increase on the debit side,
Revenue.
10,500. The other one is easy. Everybody, the other one is easy. Revenue. Credit 10,500. Assuming no bank charge, no return. Assuming make it easy. Okay, this part settled, but the thing we're gonna talk about today is how do you handle the inventory? What is the cost? What's the cost? Because you deliver 3,500 units, they are from different patch, right? You have a 1,000, 1,025. So total you deliver, if you totally deliver 35, you know it's combination. You know. So right now the question come here is, how do you report your cost of goods sold? So there are 3 ways in the book. If you read the book, there are 3 different ways. Either FIFO, first in, first out. They really mean May 5th 1,000, May 9 1,000, and May 11 1,500. So your cost is 1,000, 1,500, and 3,000 from May 11. That is the cost. Am I right so far? This is called FIFO. Or LIFO. Last in. Oh, by the way, this is stuff. So if we use a FIFO, okay, how much is total? 1,000. Am I right? Am I right? If we use a FIFO, it's the 5,500. Am I correct? Right? So if we use FIFO, first in, first out, we deliver the inventory cost 1,000 here, 1,500 here, 3,000 here. Am I right so far? So total is 5,500, right? If we use a LIFO, that means 25 here, 1,000 here. So that's a total 5,000 plus 1,000 is 6,000. The third method is called weighted. Weighted means you just average. You have a total cost 1,000, 25, 7,500, right? Your 3-patch total cost is 7,500 divided by how many units? 4,500 units. So you get the average. That's the third method. Right. So let's leave alone the third method. We just compare the FIFO and LIFO. Everybody see the problem here. If you pick up the FIFO, your cost is 5,500. If you pick up the LIFO, your cost is 6,000. And this difference affect your profit. Affect your profit. And either way is allowable. Either method, FIFO, LIFO, either way is allowable. However, the GAAP or the tax law require you to stay with the same method. Understand? You need to pick out the same method, either FIFO or LIFO, all the way apply to item A. But the funny thing is, you can pick out totally different way for different items. Understand? Say you use the FIFO for item A, you use the LIFO for item B, you use the average for any other thing. It's allowable. But this make the accounting people life very miserable. Very miserable. You need to stay with different item, different way. Luckily, right now everything is done by the computer. Everything is done by the software. It's so lucky. But go back to 30 years, 50 years, everything is done by the manual. Then it's headache. Alright? So let me ask you, what's the benefit if we use this example? Okay. What's the benefit to have a FIFO for this company? You see, the total sales is 10,500, right? Total sales is 10,500. However, if you use FIFO, the cost is 5,500. So you have you realize $5,000 profit. That's FIFO. However, if you use a LIFO, the profit reduced to 4,500. So what's the benefit? if we follow out this example, what's the benefit for your company to choose FIFO and recognize $5,000 profit compared to 4,500? You want to impress your stock shareholder. You want to impress your lender. You want to impress your joint venture partner, whatsoever. If you really want to impress anybody, you pick out the higher number. Understand? But what's the problem? With the higher number of profit, the problem is you pay more tax. You pay more tax. So that's another reason why you want to pick out higher number of the cost. You want to at least avoid your income tax for a while. By the end, you'll be the same, because if this year you pay lower income, next year you pay higher income. However, the only thing is you want to delay your tax. You want to defer your tax. So it's not surprise, okay? It's not surprise. For each company, you can choose one method for your financial accounting. You can choose another method for your tax. It is legal in the United States. It is not the same thing in another country. In Taiwan, there's only one system. But however, every company, they have two different accounting books. But in the United States, it's totally legal. If you want to use this method for your accounting, financial accounting, it's okay. But you just stay with it. You don't change it. And you use another method to reduce your tax liability, which is totally okay.
What does that mean? You choose one for the account.
Say for example, okay, let me give you an example. You sit here, right? If you pick, in this example, right? If you pick FIFO, your net profit is $5,000, right? 10,500 minus 5,500, right? So if your company pick out FIFO for this example, no guarantee, by the way, no guarantee, right? Your company recognize $5,000 profit, so you can impress. Compared to LIFO, you only recognize 4,500. Of course, yes, go ahead.
I'm a little confused. Why do you recognize less on one over the other? Why do you cut out a period?
Okay. Yeah, I try to compare to FIFO and the LIFO. Okay. One number is fixed. There's one number, that's the 10,500. I want to go step by step. In any step make you confused, you stop me. Okay. One number that's fixed. That's the sales number. When your company make the sales 3,500 units, for each one you sold at $3, right? That sales number revenue is fixed, $10,500. So that number fixed already. However, in order to calculate your net profit, or say your profit, we need to determine what is your cost. Understand? And right now, at least we have two methods to determine your cost. One is called FIFO, meaning first in, first out. When we use FIFO, we use total 3,500 units, right? We use FIFO, first in, first out. So 1,000 units here, 2,000 units here, another 1,500 here. So we have the cost based on FIFO is 1,000, 1,500, so make it 25 already, right? And 3,000 here, $3,000 here.
How does that change?
It did not change, it's $2.
$1,000.
$5, right?
Because when your company purchase, it purchase at $2.
Mm-hmm.
So when you purchase, it purchase at $2. So when you purchase, it purchase at $2. So when your company purchase, it purchase at $2. So when your company purchase, it purchase at $2. So when your company purchase, it purchase at $2. So when you purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it purchase at $2. So when you company purchase, it The reason why each number is different because you purchase the item from different vendor or different market, so you have a different unit cost here. If each patch inventory is the same cost, you don't have a FIFO LIFO issue. Understand? When we talk about FIFO LIFO issue, only because your company purchased from different resource or different market, and the unit cost is different. So far, you got clear? So if we use FIFO, first in, first out, discount, and this one we use 1,500 units. So make it total 35. 1,000, 1,000, 1,500. Because your sales is 35 units. So far, okay? Or any other confused? So this is a FIFO. However, when we use a LIFO, opposite down, we use last in, first out. So total 3,500 sales come out from 2,500 units, the last in. The second last is this one. So I have a total cost of 5,000 here, plus 1,500 here. So your cost is 6,500. So when we talk about the profit, revenue is the fixed number, 10,500. That number does not change. But the thing affect the net profit is either you choose FIFO, your cost is $5,000, or you pick out the LIFO. I'm sorry, FIFO is 1,500, and then the LIFO is 6,000. So you come out different net profit, 5,000 net profit versus 4,500 net profit. So far good. So come up with two different numbers. One is net profit 5,000, the other one is net profit 4,500. So I just want to explain to you, if your company choose FIFO, then you have higher net profit. With the higher number, you can attract or impress more on your investor, your lender, your potential partner whatsoever, or potential purchaser. Some company would like to merge your company. You can impress those people, those parties with higher profit number. However, when you deal with IRS, you want to reduce your tax, right? Makes sense. So you want to report lower profit. And the way to make your company report lower profit is you pick out higher cost of goods sold. So this is the major difference between financial accounting versus tax accounting. And in the United States, in certain way, it is legal, it is allowable. You choose one method to do the financial report, the other method to do the tax. Why? Why? Let me tell you why, okay? Because there is no guarantee you choose FIFO, you always report higher profit. There's no guarantee. It only happens here. Again, there's no guarantee you choose the LIFO, you will report lower profit for the income purpose. There's no guarantee. So once you choose FIFO for your financial report, you need to stay with. You cannot change that. Once you pick out the LIFO for your tax, you need to stick with it. So probably opposite, when you pick out the LIFO, you report higher net profit, probably. So this is the reason why in the United States, it is allowable for the company. You pick out different method for different purposes. You even pick out different method for different items. It's okay. Only issue is you need to stick with it. Once you choose this method, you choose. You stick with it. So, anybody got confused here? FIFO LIFO is very, very popular accounting, financial accounting issue. It's big area.
So how the company keep the record. Report financial report is FIFO, and tax
They
report
need
is
to put it under, yeah. He just asked me, if your company choose FIFO for item A, or choose LIFO for item A, how can you make a record? The way to do the record is always on the footnote. Footnote. Okay, when your company prepare the financial report, always come with the footnote. Say number 1, number 2, number 3, number 4.
But if you report the LIFO to the tax report, then this
No,
not bad.
when you report, no, it will not mess up because when you do the LIFO for tax, it's on the totally different report. It's not on the same page.
So totally different.
Of course, you cannot report on the same page. You need to designate this is a financial accounting, and also designate this is a tax for the tax. Remember last semester? Still here, I believe.
I mean, tax can be different method to the
Let me show you.
financial report.
Yes. I believe still here. Hopefully still here. Remember at the beginning of this semester, I showed the tax form. Hopefully it's still there. Oh, for some reason I did not keep it. Yeah, remember when I showed the 1020, right? The tax for the corporation income tax. On the page 4, it is income tax, and it's a balance sheet and the income statement. That's for tax, and that number could be different from the number on your financial report. You just need to explain why it's different. That's it. So I just want to use this example to remind you, financial accounting is not for tax. And it is legal. It is no problem. It is legitimate. For the company in the United States, you put together one set of number as a financial accounting purposes. And that number, if you check each big company online, that is the number on their financial report. However, for those number on their tax, it is confidential. They don't need to disclose this to investor. Every number appear on the tax return, they are all considered as confidential. As an investor, we don't see it. We never know how much money Microsoft the company paid to the IRS. If they don't want to disclose to you, you can ask. That's only between the taxpayer and the IRS.
IRS can question you based on financial report.
Of course, always. Yeah. But as long as you can explain to them, even though this is the number I report on the financial report, however, why I report a different number on the tax, as long as you can support your number. So this is why I say in the United States, totally legal for you. Yes?
Retrieving example is as a retail industry. What about we totally calculate the labor cost? Like for example, I do the iPad, and I after sort of appearance design to design my iPad. So when I sold the first iPad, when I sold sell the first iPad, what kind of calculate the labor cost?
Okay, right now, I just simplify the cost of goods sold a lot. Okay, because there's one area is called cost accounting. For cost accounting,